Hi, I'm Josh Brown. Did you ever wonder why so much of financial commentary involves these very obscure stats and setups that purport to tell you what's about to happen when in reality, such a thing is ridiculous and impossible?
And did you want to know the answer to what happens next?
Once again, stepping all over my intro.
I mean, the ridiculous intros will be stepped all over.
All right, listen, stick around. We're going to talk about odd stats. All right, Mike, let me read this right from your blog post because it's hilarious. What happened, quote, what happens in the following week on average when the VIX finishes positive but is below 20, when the S&P 500 finished down more than 1%, while above its 200-day moving average, while gold gains 2% and oil falls 2% during the third week of a leap year? You didn't tell me if there was a Republican or a Democrat in the White House. But like, all right, so you're making the point that these are like, I guess, interesting factoids, completely useless for investors because even if all of those things do line up, and that's pretty far-fetched, still, you could basically flip a coin about what's going to happen next. Would you say that's about accurate?
I would.
Okay.
I just think the idea that more data is good for the end investor is ridiculous.
Ridiculous.
And if you think about some of the strategies that have been struggling the most over the past few years, it's probably the people with the highest mental horsepower and the most data, and the people that are just the smartest people in the industry.
What are they doing to themselves? They're like pouring all this information into software programs and like running in circles.
I mean, it's been a challenging environment, obviously, so it's not a shot at them. It's just the point is that more data does not mean like better results.
Well, of course not, because you're up against people that have an endless amount of data and can keep generating derivatives of that data. Like they'll never run out of analytical tools for the same information set.
And so how
do you know what to follow?
It's clicky as hell. Right, because it gives you like this illusion that here's what happens next.
Right. So we're both fans of this guy, Odd Stats, and he's a
parody.
He's a court jester.
Yeah.
And he's like running up these like ridiculous. Oh, it's 10 a.m. The last time the S&P was up before 10 a.m. on a Tuesday when it was snowing in New York.
Best Buy reported earnings.
Right, and then he'll like actually run the numbers though, like with a straight face, and then there are people. Fucking
his mentions are hilarious.
Yeah,
it's like the comment section.
Right, there are people with follow-up questions. It's really unbelievable. Not that there are people really trading on it, but just the fact that there are people who think there might be some secret alpha embedded there is wild to me. But why am I surprised?
I don't know. Why are you surprised?
Maybe I shouldn't be surprised. How do you know when something is relevant and when it's not? When you're looking at data sets?
Big picture stuff is relevant, but there's a limit. Like if you know that historically the U.S. stock market is up on calendar years like 73% of the time.
Right.
Well, then that
on an annual basis.
Not rolling. But rolling is probably the same thing, 75% I think. So that should just tell you that like risky assets pay you for that risk.
All right,
but it doesn't tell you that like 70. It doesn't tell you that if they were down 3 years, then they're going to be up on the fourth year.
Okay, let's do a little lightning round to close this out. I'm going to name a data set. You tell me if you would trade on it or not. You ready? Like you have to pick one, though. Okay.
What do you mean have to pick one?
You have to choose one of the ones I'm going to give you.
Okay, go.
All right. I mean, you could say no initially.
Go.
Intermarket analysis with commodities. Like I give you oil prices versus the S&P. You trading on it?
No.
Okay. Seasonality.
Definitely.
I tell you what month of the year is coming up. What the probability of that month being up.
No, that's the. No.
All right, presidential cycle.
Stop.
Yeah. Who's in the White House? Like which party?
Next.
Okay. What else could I give you? Oh, I'll give you currencies, global. Anyone you want. Maybe
yen.
Maybe yen.
Okay.
Why?
What else?
Because that'll tell you risk off.
Yeah.
Okay. I'll give you the last 6 moves the Fed made.
Yeah.
You would trade on that?
Yeah.
I'll give you the next one move the Fed is about to make. Would you trade on that?
Yes.
You would?
Yeah.
Like very simple binary. If they cut, I'm buying.
Yeah.
If they raise, I'm not.
Yeah.
That wouldn't work. You'd get killed.
Okay, but it's more
Better than
reasonable than intermarket analysis with commodities.
Right. All right. Well, listen, there's a lot of data out there. I think what we're really trying to say here is
be
that
careful.
it's not real life. It's not real life. Like it's not a reflection of what the market's going to do just because you happen to notice a pattern of data repeating itself.
How about midterm elections after whatever stocks were never down? Wasn't that the stat floating around last year? Like midterm elections are really bullshit. And then, we had a freaking bear market.
Right. 2 of them. We had 2 of them last year. Did we not?
Well, no, the midterm elections were in the middle of the year. And then we had, weren't they? Oh.
No, but within the calendar year of 2018.
No, but after the midterm election, we had the December bear market.
So we had a correction, and then we had a correction that turned into a bear market in a mid-cycle election year.
However,
so let me ask you a question. Out too.
Wait.
What?
Would that sort of analysis even pick up on the bear market? Because it's over now, and so they usually do like 6 months later. It's usually 12 months later. It doesn't tell you what happened in the interim.
So the clock hasn't run out.
So
yet
another reason why all that statistics is garbage, because it tells you what happened 6 months later, 12 months later. Well, 6 and 12 months later, stocks are usually up anyway, regardless of whatever happens. It doesn't tell you what the deepest drawdown were in between those 2 periods. It's like a survey kind of.
If you're doing rolling 12-month returns and you know that stocks are up almost 3/4 of the time, probably rolling 6-month returns, it wouldn't be that far away. Maybe it would be 65% of the time.
But I'm saying, even if you had that information, so what?
Yeah. All right. Throw it out. Have fun with it. Retweet it only with tongue in cheek. Let us know what your thoughts are on data sets in general, knee-jerk reactions to odd stats. We'd love to hear them. Go ahead and follow us. If you do not, subscribe to the channel. We love our subs. We'll talk to you soon.